Hi, folks. This is Sean Hyman from the Logical Investor, and I hope you guys had a great 4th of July. And wanted to go ahead and resume our weekly videos. We were off last week for the 4th, and so I wrote this recent article. I hope you'll click on and read and share. It says "Don't count commodities out," and I give some kind of a long history of commodities and look there and some different things where I think commodities are going and why and the types of moves they can make and stuff. By the way, there's videos and ads at the bottom of articles and newsletters and things like that. That's the publisher allowing advertisers in and stuff. And again, I don't have any control really over that. And so I would urge you to focus on what I write and my content in my videos. So if you hear my voice or see me writing it, then in which you'll see it'll say Sean Hyman on it. Then that's me, and anything else on the site you need to assume that is not me, and that just because it's on the site doesn't mean that I'm for it or approve of it or believe in it or whatever. So just know that. So check that out. I believe you will enjoy that article, and click the Facebook share button and share that around if you would. So the dollar, you can't see it as much on the weekly chart, but on the daily chart it's more prevalent. But it's backed off over the last little bit. Now that the Fed has talked about lowering interest rates later this month, and the dollar itself, the dollar index, is at the top of one of these long resistance areas that you can barely see it on the chart here, but like right there, there, and even back here. These were all resistance zones that the dollar had a lot of trouble with, and so far the indicators are slumping, and so with that rate cut possibility, that is not likely to help the dollar ETF go higher. And what I find fascinating is that in general, UUP is supposed to track the USD, which is the US dollar index, but it's not done such a great job of doing it lately, because you'll remember UUP is up here, equivalent up here, and the US dollar index didn't hit that. As a matter of fact, the UUP comes up here where the US dollar index stops here. It matches it here and it falls way short of it here. So there's a lot more people, in my opinion, plowing into UUP and focusing on that being what the dollar's doing, rather than focusing on what the actual US dollar index is doing. So far the dollar index hasn't been anywhere near its old high. So 98.26 was its recent high. It's at 96.70 now, and then 103.82 was its high here. And so far this trend line has still been broken. 1, 2, 3, 4, 5, and this is probably an A, and this is probably a B. And we don't know if B is done yet, but there's a good chance that B is done, with the Fed about to start doing at least some rate cuts, one at the end of this month and possibly one or two later on in the year. Unless things get even worse, then they may even do more. But you've got the RSI slumping. You've had the MACD slumping for a while. Again, you got a much lower high here than here. You've got the any way you kind of draw these lines, you've got the dollar index testing or breaking that. And so once it breaks below the 200-week moving average, we will probably see that even accelerate to the downside. So I'm looking for this to head lower. Somebody asked me on the site how much lower, and I believe that it could be anywhere in this former range right in here. So at least down to 84 on the dollar index. Whoops, ignore that one. Down to probably a maximum of 74, and the likelihood being probably somewhere in between. So keep in mind a move from 96.70 to even 84 or 85 is causes a big move in our positions, because the dollar tends to the drop in the dollar tends to produce an even bigger drop in metals and foreign currencies, and an uh, uh, even bigger increase in metals, and even bigger increase than metals do on things like GDX. So there's like amplification at each level is what I'm trying to say, in case I didn't say that well. So it doesn't take a whole heck of a lot of dollar drop to do us quite a bit of good. So just going from 96 to 85 even, for instance, does us a lot of good in our positions. So the dollar UUP here has backed off here, but it's also back off of this peak here. The selling pressure has increased, MACD slumping, RSI's overbought. And then USD, of course, doesn't take into account today's activity yet. But you can see that it went up here. This is the more recent highs in the 98s, and it's still challenged to even reach those, having come up to the 97s and selling off. MACD lower, RSI overbought, etc. So that's not looking good for the dollar, but that is a good thing for our positions. Now, so here's the funny thing about stocks that is that people view about stocks, that they don't view anything else in life that way. They get more excited the more it goes up in price. So let me just give you an example that's totally outside of the stock market. Let's say you're eyeing a house on Realtor.com or something like that. You're viewing a house that you're thinking about buying online, and it's $300,000. And again, depending on where you live in the country, that might be a cheap house, it may be an expensive house, whatever. So don't disregard that. But let's say that you're thinking about buying a $300,000 house, and then all of a sudden something happens and it spikes up to $350,000. So it's the same house. Do you get more excited that it went from $300,000 to $350,000 and you're inclined to want to buy? Or are you less inclined to want to buy because it jumped from $300,000 to $350,000? And then would you be more inclined to buy if that $300,000 house happened to decline to $250,000 while you've been watching it? Would you be more apt to buy it then? Of course you would. Same house, same quality construction, same neighborhoods, same schools, same basic crime rate and cost of living in the area, and location to businesses and whatever, and so apples to apples. Yet the price changed in your favor. So yet people don't get this way with stocks, and it's the funniest thing. So they get more excited when the S&P 500 goes to 2,500 or 2,700 or 3,000, stuff like that. And they get this sense that, and even my subscribers sometimes get this way, they get this sense that they're almost missing out on something. But it's like chasing housing prices higher. And we know what happened when people chased prices higher in 2005 and 6 and 7, right? 2008 came and 2009, and it was brutal. Why? They were over enthusiastic. They were overbuying in housing, and so they were something was going up, and it was going up higher, and there was a great vibe about it and great sentiment about it, and everybody and their mama was wanting to buy a second house or flip a house or figure out what they could do to take advantage of that. And yet, when there was the most focus on it, the most positive sentiment on it, all that, there was also the biggest overvaluation on it and the biggest correction coming on it. And for some reason, people don't make that same correlation when it comes to stocks, and I don't know why. It's like they have been hypnotized or something to treat stocks differently and to view them differently than they do everything else in life. I mean, if you go buy a piece of clothing, would you prefer to buy it lower or higher? Do you get more excited when that purse, that jacket, those shoes, whatever it is, goes up in price? Are you more inclined to run to the store and want to buy it because it went up in price? Or are you more inclined to buy it when it hits the sale rack and even the clearance rack? So that mystifies me. while I'm on the mystification thought process, the other thing that mystifies me is that people get scared and they second guess when you're buying value stocks. However, would a value stock be a value stock if everybody saw the value in it? Would a value stock be a value stock if sentiment was good and people wanted to buy it? Of course not. So sometimes when people say, what do you think about XYZ stock? The first thing I go look at, even sometimes before fundamentals, even though I'm not getting into a stock without the fundamentals, but sometimes I'll go look and see how the price of the stock is acting. So let me just give you an example. We're not in this stock, but Microsoft. The sentiment is super positive. People think it can go nowhere but up. Some analysts out there just put a $150 price target on it. You know, that it's funny, as these things go up, they increase their price targets, and as they go down, they sometimes decrease their price targets. So analysts and price targets mean nothing. But you see this over exuberance here that has happened with the price so far away from the 200-week moving average. So I don't care if it has pristine fundamentals. There's so much overly bullish sentiment that I know's out there, even without flipping a TV on, listening to the financial media, scouring the internet. I can look at one chart in one time frame, the weekly 10-year chart, and when I see a price that's gone parabolic, the price is way away from the 200-week moving average, I know there's an overly bullish sentiment. People have been nutso about the stock for the longest, and people are all in on it, and they think that it can't go down. Is there any value to be had in that stock? Of course there's not, because the sentiment is too overly positive and everybody and their mama wants it. So of course there is, and Microsoft has great fundamentals. It just has a too high of a price. It's got too, the sentiment is overly bullish. Somebody asked me about this one this week, Oracle. Again, another stock that's good fundamentally, but look at where the price is. At least a 10-year high, maybe an all-time high. The price, at or near 60, and then the 200-week moving average back here at 44. What's the the downside risk potential versus upside reward to that? It's flipped. So I would have no interest in it, and if I owned it, I would probably be likely to consider selling it because my downside risk is at least to this 200-week moving average, if not further. And is my upside from here, that move, going to be, this much distance more to the upside? Probably not. And you've got RSI dying off and MACD not quite as sure, and the price extended away from the 200-week moving average. And what's that done when that's done that in the past? It's pulled back to the 200-week moving average and then some, more times than not. And it's not that it always has to come back and actually touch that average. Sometimes it'll be a little shy of it. Sometimes it'll go a little past it, a little under it. And then when you finally get to the top of wave 5, you get an ABC move. That C wave goes way under the 200-week moving average. So your ultimate risk is a minimum of between where it's at, the 200-week moving average, and a maximum. I mean, it could be far further. I mean, it could cut in half. It could more than cut in half, etc. So it's one of the first things I look at, because I won't even buy a fundamentally sound stock. Now, the stock, it may be fundamentally sound, but it won't be at a good fundamental price if the price is crazy high like this, because the sentiment's too great, too positive. It's too much of a focus. People think that it can only go up. Nobody's getting burned by it yet, because everybody that was in it is up on their money. And they think it can only go up, and you can't ever convince them that it can go down, because their recent history teaches them that all it can do is go up. And they get their confidence in the market by looking in the rearview mirror by what has happened, and that's the dumbest thing in the world. That's like saying, I'm going to buy a house in mid-2007 because over the last number of years, housing has done nothing but go up, and so it can do nothing but go up, and after all, everybody needs some place to live, right? That's always their justification for it, right? So just because people need a place to live doesn't mean that prices have to eternally go higher. We saw that in 2005, 6, and 7 as prices ran up, and then mid 2007 and 2008 when prices, crashed lower. People still needed housing, but they can go from owning a house to renting. They can get priced out of a market. They can get to where the prices have gotten too high to where their paychecks can't afford the payments on it. There's all kinds of reasons why that the buying can dry up. The same thing happens in stocks. Eventually, all the buyers have bought. They've bought all they can, and you don't even have to at first have an abundance of sellers for stocks to fall. You just need to have an absence of buyers, and so that can start the initial sell-off. All right, so enough about that. Want to just point out one last time that while people are so bullish about the S&P and Dow and Nasdaq and this just hit a new high and that just hit a new high, look at the risks. Look at the risks that have happened before, and look at the slumping indicators, and that's not a good sign. They're making a big hoopla about Dow hit 27,000 and it did, and of course so far it's not holding it. Now it might be different by the time the market closes today, but it gets up here far away from the moving average and has a sell-off. Gets up here and has a even bigger sell-off. Gets up here, guess what? There'll be one that'll be far bigger than this one. And I find it interesting that while this goes to a new high, these indicators aren't. RSI is slumping, MACD is slumping. So it's really kind of flat up here, which is a lack or a loss of momentum. Then you have got, to me it's a false sense of bullishness. Again, the Nasdaq, when it got up around these regions, it's had many sell-offs here. It's had a major sell-off here, another mini sell-off here, and one bigger than this sell-off is coming because we are. Amazingly, this could still possibly be in wave 5 for the overall market. So if so, you still got your ABC to go, and again, you got slumping RSI, MACD, and the price as far that it's been in a decade away from its 200-week moving average. And when you're at the end of wave 5, they're not just going to eventually go down to the 200-week and stop, even though that would be a huge correction, 81.83 presently to 63.18. That would be a heck of a correction, but this would go far lower than that. So we could actually see that index do something like come closer to cutting in half. So, and then this is something that doesn't get a lot of media coverage and press. The Russell 2000, and of course you've heard me mention it several times on here. If the market's so great, then why are small cap stocks doing so poorly? So small companies ought to be thriving if America's doing so rockin' hot great. And so what you've got so far is the RSI slumping. You got the MACD slumping, and it slumped even more here recently. You've got the price breaking this big run up and massive sell-off, and it hadn't come anywhere near these old highs. 1742 here, and we've hit 1600s and 1554 today. And this 50-week is slumping lower. The 200-day moving average is lower as well, and it keeps putting in more recent lower highs. So if everything's so peachy out there, then why aren't small companies benefiting? And they're not. If everything's so peachy out there, why is the Dow Jones Transportation Average not prospering right along with the Dow Jones Industrials and so forth? There is a thought process in some circles of technical analysis that says a market rally is only bona fide if the Dow Transports and the Dow Industrials are both breaking out to new highs together. And so you've got the Dow barely squeaking out and edging out a new high, just enough to make media headlines, but really almost more in a toppy range. And you've got the Dow Transports nowhere near their old high. So 11,623 was the high here. 10,369 is where we're at right now. And these highs have done nothing but go lower. You've got your MACD. It's been heading lower. You've got your RSI that's been slumping for a while and has even steepened its slump more recently. That's not bullish. Your 50-week and your 200-day moving averages are already downtrending. That's not bullish. So transportation stocks are not prospering. Well, if everything's so good in America, then why the heck aren't transportation stocks prospering? So I do think rate cuts are justified. I was on record as saying that I felt that the last couple of rate hikes were a mistake, and now they're having to erase those Fed rate hikes with rate cuts, and so that was proven to be right and accurate. And where I got a lot of that opinion was the softening data economically, and the Russell 2000 and the Dow Transports not joining the rally that the Dow Industrials had. So let me see if I can do this real quick. Let's see. I believe it's this way. Hang with me for 1 second. Price behind price. So I'm putting the transports back behind the Dow Industrials. So the Dow Industrials are the red and black line, and the candles, and the transports just this black line chart. And you'll see that for a while they have gone together, but recently they have diverged. The Dow Industrials are up here, and the Dow Transports had their last rally high here, along with the industrial. So they both rally here. The problem is they diverged here, and the transportation stocks turned down and went lower while the industrials went up. And so I don't believe that this is a bona fide rally. So when transportation stocks are flashing warning signs, that's a problem, because most of our goods that we buy in a store, a retail outlet, online, doesn't matter if it's Amazon, doesn't matter if it's in a retail outlet, wherever it's at, it gets shipped and sent and transported by 18-wheeler or by ship or by rail, or so these transportation stocks are key, and they get very little attention from the media. But there's a big divergence here that that I just believe is definitely worth pointing out. So I'm going to take that off of there again. Those are big concerns for me: the Russell and the Dow Jones Industrials. So to get that zoomed in look on the transports, here's that recent slumping that I've talked about. Here's that declining 200-day moving average. Here's the declining MACD on the daily. Here's the declining RSI on the daily. To get the Russell 2000, here's that declining 200-day moving average, those lower highs. Here's the declining RSI. Here's the declining MACD. So, these are some of the most economically sensitive areas. Small caps tend to turn up in business in economic cycle upturns pretty quickly, and they're very economically responsive, and they tend to turn down quickly and first when things become economically not as responsive and downturns are upon us. And so same thing for transportation stocks, because they got to transport it before it can get to the retail outlets where you can buy it. And also, if you're not ordering stuff online, stuff isn't getting shipped out either. So so there's all kinds of reasons why transportation stocks are a good barometer and signal as well. Okay, so enough of that. Let's go on to our positions. I felt that was worth taking a little bit of time there. So GLD has made a recent high that's higher than these last couple of highs on the weekly chart. So this is a breakout that has been sustained, which is awesome. So you had 131s here, you had 129s here, but whether you look at it, that way, or your 131s here, and you've been as high as 135s, and you're at 132.52. Now you're at a higher level. Now, what can you get? Of course, you can get a pullback before heading higher, and that could be either a shallow or a bigger pullback. So there's several things that can happen. We've already been through part of a consolidation. We can go up from here. We can have a minor correction of sorts and go up from here, or we can have a much deeper correction where we come back closer to the the 50-week and 200-week moving averages and then head higher. And I'm not stopping at 150 because I think it's a stopping point necessarily, although it is a big round number that will pose some challenge because you have former support that turns into future resistance around that 148, 150 area. So we are grossly overbought here, but the trend is still higher in the MACD. So we could get consolidation and advancement or one of these couple of pullbacks. If we get the advancement or a small consolidation pullback and then up, those are not near as big of a deal as to realize the possibility and to be emotionally ready if there is a steeper pullback, on GLD, say from 130s to 120, 122 or whatever, and then go higher from there. That requires more psychological readiness. So I like to look and see how far the price is away from the 200-week moving averages and always be psychologically ready and prepared for any time those were to go, to potentially go back to those levels. Doesn't mean it has to go back to those levels, but it just means that it can. And if it did, I wouldn't second guess anything at all, and it would still be making higher lows because you had the ultimate low here at 100, and then it went to 107s, and then it went to 111s, and you could draw this, a couple of ways, and you still come out about the same area. So, this could still be making higher lows and now a higher high, even if it came back to anything higher than 111. I don't expect it to pull back that far, but I'm just saying it could. And so you want to be cognizant of that and psychologically ready for any good sized pullbacks. If the dollar starts declining quick enough, fast enough, we may not get much of a decline at all, and this little bit of a decline may be all we get. But it's nothing for the price to come back closer to 50 and 200-day moving averages. So just know that you can always have that happen at a bare minimum. So 125 to 120 would be very common before heading to something much higher. Again, if this happens to where we go sideways and then up, really requires no psychological readiness. And if we consolidated already as much as we're going to consolidate with the pullback and sideways action here and just go straight up, that requires none either. So it's really these deeper pullbacks that you have to be ready for. And the difference between where the price is and where these moving averages are on daily and weekly charts helps set you up properly for what pullbacks could potentially go to. All right, so we've got FXB next, and this one's been all over the place in the near term, but sometimes I think it's better to take it in the context of the longer term chart. So FXB had its ABC downtrend end coming into 2017. Here's wave 1. Here's wave 2. We're currently at 121.39. The ultimate low is 117.48. So as long as it stays above 117.48, then this is wave C, 1 and 2. And what does that mean? We've got wave 3 to go, and which will be nice and nice and high, and it will shock a lot of people that the pound can do that because they've been so used to all of this, and this happening that they're not bullish at all on it, and they're not looking for that wave 3 to come. But the RSI keeps getting stronger. MACD keeps getting stronger. The selling pressure is abating. It was at its highest here, then it was second highest here, and then it's dropped off considerably since. And so that's a bullish sign. So very bullish on the pound. Just requires a little patience, and it will benefit from the fall of the dollar as well. EWW, they had I think it was a financial minister or something like that resign recently and caused a little near-term volatility and stuff like that. But again, if the dollar heads lower, the Mexican peso becomes more stable, and institutional money is more apt to flow into emerging markets with that being the case. And so just that dynamic alone, I think that it does well. And then when you look at it on the weekly, here's your a very unusual ABC here. So I believe your C bottomed here. Your point of maximum pessimism actually stopped right here just before 2017, which corresponds to this low. And then this low that went a little bit lower had even less selling pressure, and now that selling has really dropped considerably more. So this is broken a downtrend line and is firming up. This is putting in a higher low here on the RSI. There's a lot of reasons why I believe that we are at that bottoming process. So two hurdles that it needs to overcome. One is its 200-week moving average here at 46.60, and then the other is this declining line of resistance right here, which is whatever 47.50 or so. So once it overcomes that, it could really take off. So it's done a lot of consolidation over the last 2 or 3 years, and I believe it's ready for that next leg higher. So this one could easily, go up to these old highs for sure, 65-ish or so. Don't know that we will necessarily be in it that long, because again, you should have gotten your averagings in when we started from 52.64 and it went all the way down to 36.41. So you've got or at least a couple positions in it, we'll put it that way. So you should at least have something in the 50s and something in the 40s at a bare minimum, we'll put it that way. So your blended average is low enough that once we get back to our original entry price, you'll be up on your money in the 56s, 57s. So when this goes 60, 62, whatever, you should be up quite a bit on it. And again, we probably won't push 65 or 67, because the last couple of times that was the very tip top. So once this gets above 55, it could really spike higher to 60, 62, whatever. And as it gets around that area, we'll probably look to take profits. So then we got GDX. It's prospered recently right along with gold. But just know when these have these big pops and big run-ups that they can also, if they have volatile upside, they can have volatile downside. But when they have volatile downside, that's when people get all in an uproar about it and people discount upside volatility. They have no problem with that. They just have a problem with this. So if this were to do like this before doing this, that's when people have a problem with it. Again, this didn't bother them at all, but this bothers them, and it's a similar volatility, just one's upside volatility, one's downside volatility. This really takes no emotional management at all, except to manage your greed factor. But the fear factor, if there were to be deeper pullbacks towards the 200-day moving average, that's what has to be managed if this were to go from 25 to 20 or 21. It would be more likely that the pullback would be more shallow, it probably 50-day moving average or so, and then heading higher, or even some kind of sideways consolidation within this area and then head higher. Those are really two more likely than the deeper pullback, but you always want to have yourself emotionally ready and prepared for a deeper pullback if it were to come. Again, if you have expectations set properly, you rarely get emotional. So again, it's like the analogy that I've used in newsletters before and in videos. If I tell you a car is stalled out in the middle of the road just around the curve, but I forewarned you about that, you're going to slow down, you're going to take it easy, and then when you get around the curve, you're not shocked or caught off guard because that car is there, because I told you it was there, and you set your expectations for there to be a stalled car in the road, and even thinking ahead what you're going to do about it to make sure that you don't hit it or intersect with it. But if you have none of that knowledge, and there's a stalled car just around the curve, and you're going, interstate speed or whatever, and you're going around that curve, and then you see the stalled car, then you might panic, slam on the brakes, snatch the wheel one way or another, and spin out of control, whatever. So it's a much more emotional process. So what I do all the time is tell you about the potential cars that could be around the corner, so that you're prepared for them. And if they're there and you do get the pullbacks or the corrections or whatever, then you're emotionally prepared for it. And then if they don't happen, then that it takes care of itself. But emotional and psychological management is one of the biggest keys to successful investing. I posted that quote in one of our newsletters and on the site that was a quote from Warren Buffett that basically said something to this effect: if you can't control your emotions, you're not going to be able to control your money. So it is imperative that you have emotional control and that you not be motivated by every wiggle and squiggle on the chart, up or down. So, sometimes people get caught up in the gaps down, and they don't get caught up in the gap ups. So the gaps up, that are here, people love, but the gap downs, they, those gaps down, they second guess themselves, second guess the stock, second guess the strategy, all that kind of stuff. But if they look back even over the last year, there's all kinds of gappiness and white places on this chart where there was literally no trading at all at different intervals. And so that should tell you something. And then when you look at long-term charts and you see the wide volatile swings that this can have in its upside volatility potential and its downside volatility potential, again, you should not be surprised. Oh my gosh, this stock's volatile. The last 10 years should have told you that by just looking at a chart, even if you never had any history or any investment in the stock to begin with. So there's a lot of things that you can derive from the weekly 10-year chart. And I don't, sometimes people say on the site, I looked at the weekly 5-year chart. I never encourage you to look at the 5-year chart. I encourage you to look at the 10-year chart, and you can get those for free. And I do a video in the Ask Sean section. Let me see if I can find it. How to set up your charts right here. So you click on this right here. There's a video that I've done, how to set up your charts, and you can have your charts just like mine. So just know all of the foundational videos that talk about fundamentals, technicals, how to set up charts, sentiment, the fundamentals that I find important and why, Elliott wave counts and why they matter, and all this kind of stuff. All those are in these foundational videos that are on the Ask Sean page. So I would encourage you to look at them on your computer or your laptop and or tablet, but particularly a computer. All this format shows a lot better, and go through those videos. And I would encourage you to periodically re-go through those videos, because you're apt to lose sight of some of those things, and you're also apt to pick up something that you didn't pick up before. So even Tiger Woods, who is some of the pros of pros, goes back and has people train him and go back through the basic golf swings. And you think, my gosh, why would you go back through the basic golf swings? Because he brings himself back to the basic fundamentals and basic roots of it, because he can get away from the fundamentals and he can get sloppy as it concerns golf swings. And again, I know nothing about golf swings. I've got a friend that's a semi-pro, and he's a golf instructor. But aside from that, I know nothing about it, except for hearing Tiger Woods saying he does that. And so it's very important. So in your investing, you're going back to the basic swings as going back to these foundational videos found on the Ask Sean page. So LPL, definitely very bullish on it. I expect it to come back up to the $15 to $18 range on a volatile upswing. And it's like I've said in many videos before, when this happened, they never expected this to happen. When this happened, they never expected this to happen. When this happened, they never expected this to happen. When this happened, can you guess what I'm going to say next? They're never going to expect this to happen. So the MACD's been firming up on the weekly. The RSI's been firming up on the weekly. The price is very far extended away to the downside on the 200-week moving average. And when that happens, it eventually returns to that moving average and then some. And so I'm looking for there to be a pop higher. Now, thankfully, this doesn't have to go up here to the $15 to $18 area for us to profit, because we started getting into it in the 13s, and then it's gone all the way down to the 6s. So we've got an original entry and then an averaging and then an averaging. And so you should be, break in at 10 or 11. So when this goes back to 13s and we just get back to our original entry price, you should have a very nice percentage gain, and it never even have to go near 15 or 17 or 18 again for you to have a very nice profit. So you don't have to have with the way that we buy and the way that we capture value, most people have to have this kind of action. You know, they in other words, well, let me actually draw it a different way so it's not on the price action, because I don't want you to confuse it, because I'm actually not explaining it well that way if I do that. So I'm going to go on the white part of the chart. Most people have to have this kind of action where there's an uptrending environment for them to make money. We do not have to have an uptrend in most of our stocks to make money, because of the way that we, and I'm saying most because I can't think of one offhand, but it probably applies to all of them, because of the way that we buy and average down. So we let something drop and get into a value, and then we buy, and then we buy, and then we buy, and again, we don't have to come anywhere near the bottom. You know, it might even be the eights or something like that, where the last buy was, and one at 10 and one at 13, so you could discount that one. But by the time this thing starts making its way back up, your midpoint, you know, is you know, let's say 10 or whatever it is. So by the time it goes from 10 to 13 and change back up to our original entry point, you know, you're up 20 or 30% on your money, and this thing didn't come anywhere near remotely close to this, much less have to break out and go to higher highs. So, and not that it can't do that, not that it's not capable of doing that, it is over time, but you need to understand the genius in what I didn't originally come up with on my own. I didn't invent averaging down. I invented the way we approach it. I invented the way that we approach the levels, and the structure of, you know, where we get in price point wise and percentage drop wise and all kinds of stuff. And I'm not saying anybody else out there doesn't do that, but what I'm saying is I didn't get that from anybody else. But what I got, the averaging down concept, got it from Warren Buffett himself. He proclaims himself as a horrible market timer, yet he does good in the markets overall. How does he do that? One, he starts typically with a stock at a value. And again, in his latest years, when he's got these other guys picking his stocks, he's kind of gone away from that value type of approach. But he buys after big corrections in price. And that's why he says he loves it when his stock goes down at first on him for a good while, so that he can get lower and lower prices on a stock that he already believes in, because it brings down his average break-even price. So when the stock goes back up, that he makes money. So how does the average investor invest? The stock goes from 17, it goes to 13s, and they go all in at that one price. Well, here's the problem. It's got to go down and back to those 13, like what we got in at 13.45. It's got to go back to that before they're at break even, not profitability, and then it's got to go higher than that price for them to be profitable. So it's got to go 13s, 14, 15, 16, etc. for them to be profitable. The way we average down and we do not require an uptrend to be profitable. So the price can drop on us. We do our averagings. It comes back halfway and we're break even, and then it comes back to our original entry price, and we're up a nice market beating percentage on our money, plus any dividend or whatever that we've captured along the way in a lot of these stocks as well. So so it's a wonderful strategy. That's how Warren Buffett does so well. It's not just averaging down on any old stock, because remember, there's crap stocks out there that are on their way to zero, and they should do that. So you average down on that stock, and all you're doing is, you know, putting more exposure and risk on a stock that's on its way to zero. So it's not averaging alone that is, you know, the secret sauce or whatever. It's combining. It's starting investing when you're at a fundamental value, and when sentiment is bad and technicals, you know, look more favorable, and then having that dry powder still out there to where you've got those other two equal dollar weighted rounds that you can invest in. And I occasionally get this question, you know, hey, can I invest in more than 3 rounds? And I say no, never, even no matter how much I like a stock, because let's say, using LPLs as an example, that we got in at 13s, and let's say it's one that goes to zero. And again, I do not believe that's the case at all. since we happen to be on this stock, I'm just stopping with this chart. So if you invest your first round here, and then you invest your second round here, and you invest a third round here, and then you invest a fourth or fifth round, what have you done? You have lowered a break-even price for a stock if it bounces back, but if a stock does go to zero, what happens? You've got more exposure to that stock because you got more money tied up in that stock that went to zero, so it puts a bigger dent in your portfolio. And so that's why I'm agnostic about our stocks in the sense that I don't pretend to play the game of knowing which ones survive and which ones don't, which ones make the biggest percentage returns and which ones don't, and so forth, because I've been doing this long enough to know that it doesn't matter what you think will be the one that does this, that, or the other. It has no bearing on if it will do that or not. So therefore, I spend zero mental capacity on trying to cherry pick. So, one of the mistakes that people will make when they follow my service is I tell people to take an equal dollar weighted amount into each and every one of our positions. Why? Because we could have some be a loser and many be a winner, but you could just focus on buying the ones that happen to have just been the losers. And you would not have a winning portfolio, even though everybody who did what I said did have a winning portfolio. Sometimes people will overly weight a stock that is cheap in stock price because they're greedy about how many shares they can get, when how many shares you can get means absolutely nothing. Some of our biggest gains that we ever had were on one of the most expensive stocks that we've ever owned, which was Apple before it did its split. And it split multifold. So, I mean, it was very pricey per share, and yet it still had the ability to go up a ton percentage-wise. So don't believe this myth that, the stocks that are cheaper per share are the ones that are going to go up more percentage, or the ones that you can have more shares of matter more, or any of that. It's stupid novice thinking. It doesn't matter, and that doesn't make sense when you really think it through, and when you have the experience of seeing how stocks and markets really work. So don't pay attention to that. But I know that there are some people that will cherry pick our portfolio, and they will only get in certain ones. So they'll avoid an IBM because it was at 140s and 130s and whatever per share, and they'll major on LPL because it was at 13s and went down to 6s, and so it even went into single digit pricing, and they'll avoid GLD because it was 125 and FXB because it was 128, and then they'll cherry pick on GDX because it was 23s and went lower. So they'll load up more on that, and then they'll load up on BBBY because it got cheap and price per share. So so they'll load up on the cheap price per shares because it makes them feel good about how many shares they own or how cheap the price is per share. How cheap the price is per share means nothing. It's how cheap the price is relative to its earnings, and that sort of thing that matters something. I could take a stock, and if I slice it into more pieces, it becomes cheaper per slice, and that means nothing. So picture a pizza. I can cut that into, let's just say, 8 pieces, or I can cut that into 20 pieces, or I can cut that to where there's like 100 pieces. And how many pieces it's cut into matters not, or how many pieces you can get matters not, but it's more like what the size and value of the whole pie is matters so much more. So I'm trying to teach you institutional thinking and how to avoid novice thinking and novice mistakes. And it's one of the reasons why I encourage you to go back through my old newsletters occasionally, because I teach timeless lessons in most of those newsletters that will be irrespective of time frame. They'll be accurate and true 10, 20, 30 years from now just as much as they are today. And so it'll help you avoid a lot of those novice mistakes, because you're going to make them if you don't listen and if you don't stay mindful of them. It's just the natural bent of an investor to go into the ditch. And my job is to keep you on the straight and narrow. Okay, so let's go to BBBY. Reported earnings, beats its earnings, misses on revenue, and says their forward guidance will be on the low side of their guidance. Okay, but they did beat earnings. And so the stock was up 4% in after hours trading because it focused on the beat of the earnings. And then it was down 7 or 8% in pre-market and in intraday trading later on because it focused on the latter part of that statement. And then so now it's come from being down 8% to down 5%. So stocks are fickle in the near term. And it's all based off the same news. It's just news. It's just a matter of where investors chose to place their focus. But just know that towards the end of downward moves, and again, when you're looking at your stocks, it's always good to look at them in light of the weekly chart. I'm pretty sure the worst of the news has already been factored in by the time the stock goes from 74 to 10. So I believe that the worst of the news has already been overdone. And just like you can count on investors to overvalue a stock when it gets too high towards the top of its uptrend, which here's the top of the uptrend, and here's a wave B. So there's 5 A, B, and then here's a long C wave. So in these 70s and even the high 60s, that stock is overvalued, yet the market's pricing it there. And then it corrects it, and it will overshoot it to the downside as well. So therefore, the stock was truly never worth high 60s or 70s. And I also believe it's not truly worth 10s either. Yet the market will temporarily price things, underprice them because of fear, and overprice them for greed. So that's why I never look at stock levels as my validation of whether I'm have confidence in it or not, or bullish on it or not, or whatever. Because if you do that, you will find yourself growing more bullish the more overvalued it gets, and the more bearish the more undervalued it gets. And so it's just a stupid way to do things, just to put it bluntly. So here we are at 1094. Lowest has been 1021. We don't know if for sure this is the bottom of wave C, which is why those of you who experienced this run up and took your profits and made the great gains, you said, hey, should I go back and double dip and get back in BBBY? And I said, no, I would rather see you keep your cash for new picks or averaging down on other LI picks. And I told you that a sizable, with this run up, a sizable pullback was likely coming. And sure enough, it was from 1930 to 1094. I couldn't tell you how deep the pullback was going to be, but we are retesting those old lows now. So if those old lows of 1021 hold, then this is the bottom of wave C, and we start building a case for it going higher fairly soon and coming, going back higher, closer to this declining 200-week moving average. And we don't need it to go that high for the rest of you to get out. This go whatever 22, 23, something like that, even 21ish. With how you've been able to have the ability to get your averagings in from 2048, which our original entry, down to when it went down into the tens, you've had more than ample ability to greatly reduce your cost basis to where your average is probably somewhere around 14s or 15s. So let's just say you're 15 or 16 even with your average, and it goes to 21. You're up a good bit percentage-wise on that. So it doesn't have to go 25, 26, 27, 28 for you to be profitable. So just know that. But the reason why I said to stay out of it is for those of you who have exited profitably, is because it also could continue on wave C a bit further before it heads higher. And if it does that, I don't want you giving back part of the profit that you'd locked in and gained, before having see that turn around. Now, why do I think we are probably at or near bottoms? The MACD continues to strengthen and has for quite a while. The selling pressure had built all the way up to here. It was basically, the selling was about equal here, and then it's dropped off considerably ever since on this pullback here. Your RSI is also deeply oversold as well. So there's a lot of reasons why I think that that's the case. So this big downslide is likely over. Now we're likely more sideways, and when you look at it in the context of the bigger picture, and then we're getting ready, I believe, to head back closer to this 200-week moving average. And again, we will be out of it long before it even hits that declining moving average. So again, we do not have to have this big uptrend or this big move up for us to make quite a bit of money on BBBY. So after that, we have got CAJ. So Canon. Canon's been looking nice lately. It's been acting as a very defensive stock. And when you look at CAJ, and it's got almost a 5% dividend yield, I believe that's one of the reasons why it's acting very defensively, because it's a stock that had been beaten down that has a very high dividend yield. And so I think that it will act as a good defensive play in this environment. You've got a golden cross here. You've got your RSI strengthening. You've got your MACD that's been strengthening, which I've liked. You've got your point of maximum pessimism that peaked here. Then it was next most pessimistic here, and then it's dropped off considerably since. So that's why this is likely your bottom. This is your first higher low, and I believe we are getting ready to go to future highs. So we're getting ready for this thing to go on up. Now, could it have some pullback towards these moving averages first before heading higher? It could. So I don't know if this pullback that we got here is the ultimate pullback and now we're getting ready to advance. I think that's the case, but if not, even if it pulls back one more time before heading higher, still very, very bullish on CAJ. And I'll say the exact same thing for IBM. IBM has been acting very defensively and performing well lately, as institutions, I believe, are shifting to some value stocks that have nice dividend yields. 4.62% so it's expected forward dividend on IBM. And I'm stating that verbally because I can't tell if it's within the frame of what you can see or not when I went over to that page. But so you've got close to 5% dividend yielders on CAJ and IBM. By the way, here's another thing sometimes people do. They'll focus only on the high dividend yielders. Don't get focused on just the dividend. Price appreciation and us making a profit off of the shares first and foremost is the priority, and dividend is secondarily. If you get to focusing mainly on dividend, you've got the tail wagging the dog. It's a novice mistake. And sometimes people say, well, yeah, but I'm a retiree or I'm approaching retirement, so I need to think like that. People who focus on dividend, here's what they do. They'll go in and buy a stock because it's got a 4 or 5% dividend, and they'll go all in on that stock, and it'll have a 15 or 20% correction in depreciation. So yeah, they got 5% dividend, but they lost 15, 20% in depreciation on their overall capital to get the 5%. So it's the tail wagging the dog. It's stupid thinking. So don't think like that. If you have capital that you have to have for your daily living, don't have it invested in the market. I'm all for dividends. I love big dividend yielders, but only when it's like the icing on the cake. It's not the cake. So it's the awesome afterthought. I love, if I like two stocks and one's got a 1% dividend yield and the other one's got 3, 4, 5% dividend yield, and they're apples to apples as far as financially fundamentally sound and equally fundamentally cheap, I'm going with the higher dividend yielding. Because we don't know how long we'll have to wait in that stock. We might wait 2 years, we might wait 4 years or 5 years, and we've reaped 3, 4, 5% dividend yields each and every year while we wait for that ultimate appreciation. And so it helps us in those instances, and it also helps us to be patient while we wait, because we're reaping such a inflation-beating dividend yield while we're waiting for the ultimate appreciation, which really beats inflation. So that's very helpful. But again, don't focus on don't weight your portfolio towards cheap price stocks or dividend stocks or whatever. Take that portfolio and make sure you have got your money equally spread amongst all positions. And if you haven't got it that way yet, get it that way as fast as you can. And for your first round of investment, and then make your next, second, and third rounds of investment equal in dollar weight to the first round of investment. Make them all the same amount of investment. Don't put $15,000 in one stock and $10,000 in another and $5,000 in another, because you know what you'll have happen. Sure enough, that $5,000 batch will take off and head higher, and the one that you weighted higher, that you cherry picked and put 20 grand in, it'll go down, and the 20,000 that you lost will be far more than the 5,000 that was gained on, and you're still screwing yourself up. So there's a method to the madness when I say this stuff, and I know it's not sexy, and I know it seems rude, just monotonous and methodical and robotic or mechanical or whatever, but there's a reason for it, and it helps you to assess risk properly. Because if you don't do what I'm teaching you right, even following the stocks that I'm teaching you, if you don't average down, if you don't keep your dollar weighting the same, if you don't spread out and get diverse, you won't have the type of success and returns that you'll see other people have on this site who did do that. So it is imperative that you do that. So I hope that message gets through. So IBM I'm very bullish on. Again, when it went from 140s to 103s, people didn't think that it could go from 103s to 143s. And then I said, hey, once this happens, there needs to be a decent sized pullback, and will likely happen. And that did happen. Bounced off the 200-day moving average area, and is now heading higher once again. So I'll show you what I like on the daily chart, and then I will show you what I like even more on the weekly chart. So on the daily chart, I like it that the RSI is increasing. You've got your golden cross. You've got higher lows getting ready for higher highs. You've got your MACD, which has been improving. Your selling volume peaked here, then it went to here, then it went to here. So selling has been dropping off, so it makes it that much easier for the buyers to take control of the stock. Then on the weekly, you've got something I like even better. I know I'm probably taking a little longer on this particular weekly video, but hey, you got a break last week, so it's okay if I'm giving you a little more this time around. So so you kind of have this double bottoming here happening in the 102, 103-ish area, and I'm expecting this to head much higher, even to new highs over time. However, because of our averaging, we don't have to wait or even see if the price heads to that higher point. So we got in at 146s, and then you had averaging abilities all the way down to the 103s. So let's just say, for instance, that you got in at 146.10. So let's just call that there. And then you got in later on, and then you got in later on some here, and you didn't even come anywhere near close to calling the 103-ish bottom. You're up here at 115 or something like that. So by the time this goes down here and rebounds to say a little above this mid mark, then you're up on your money if you've done that and done that right. So you're already up on your money on the stock as it goes from 130s to 140. And so when it just comes back to the 146.10 that we got in at, you're up very nicely on your money. Now we may stay a little longer in this stock because you've got like some resistance, like the 150, 160ish or so area. So I would probably like to see it go to 148, 150 at least, if not a little higher. But this could very well go quite a bit higher because it's one of the few stocks that is huge, that didn't participate in the last run up, that has a very nice dividend yield. So you've also got the got the wrong drawing tool. Disregard that rectangle. You've got the RSI heading higher. You've got the selling volume dropping off big time. You've got this MACD downtrend that's been broken and the price heading higher there. So lots of bullishness there. So I'm even more bullish on the weekly chart, and so it's looking good. All right, KHC. So this is one that has, I believe, stabilized and probably has already found its bottom. I had told you that when this dropped and went sideways that we could possibly have one more dip or shakeout. Sure enough, that did happen. And then it came on back up, and we were back in that kind of in that range. I am eventually looking for that to break out and head higher. So we originally got in at 55.55, but keep in mind you've been able to average down into the just over 31 here and just over 27 here. So you've had plenty of opportunity to get in those averagings to where your break-even price is considerably lower. So so this does not have to go back to our even our original entry price, because this has dropped so much percentage-wise, and because of your ability to have averaged down, we can be out of it even sooner than when it hits our original entry price. So once this rebounds a good bit, then we will look to take profits. But the RSI is improving, the MACD has been improving. The selling, everybody and their mama pretty much sold here, and the selling has really waned a lot ever since. So that's a good bullish sign. So I believe that KHC is poised to head higher. I believe the worst is behind it. And I don't know. I mean, nobody knows exactly how long the sideways move lasts before it heads out. But all I know is we're patient and willing to, ride it out and allow that to head higher, and so that we can profit from that, because I believe that higher move is. And keep in mind too, while we wait, there are dividends to be had as well. Okay, then we've got E. So CAJ, IBM, and ticker symbol E are some of the ones that may prosper soonest for us. Again, we don't know for sure, but the way they're acting right now, they're looking that way. ENI, which is ticker symbol E, had a bottom here, a higher bottom here. We have broken this corrective leg here and are heading higher. We've climbed above the 50-day. We've climbed back above the 200-day moving average. We have broken this downward cycle right here. We're heading up on the MACD. The point of maximum pessimism was back here. Then it dropped quite a bit. We're in an actually bottom to the selling volume being down here, and then the selling's been further muted, and the big spikes lately have been buy spikes. The RSI has been increasing. So I'm looking for this to head higher overall. Now, with that said, could this have some decent sized pullback before heading higher? Sure, it could. Could it come back, like this? It could. I don't think it's as likely, but it could. Or could it just, take off? Sure. Or could it go sideways and then take off? Sure. Any of that's possible. The sideways and up doesn't need much emotional management. This needs no emotional management, really, as this goes up higher here. It's these dips that need a little bit of emotional management. The deeper the potential dip, the more emotional management it needs. But I believe this will go higher, and because it's been at 33s, and you've many of you probably have had one averaging down as it went to 29.94. So obviously you're not getting it at the bottom, you're getting somewhere above that. You've had an opportunity to averaging down point. Some of you probably, if you weren't watching or paying attention, may not have averaged down, and you might be in it at the 33.12 where we originally got in. It's 33.35 right now. So, but once it gets up, 36, 37, 38, etc., you will be nicely profitable. And those that did have an averaging down, you'll be very, very profitable. But I'm very bullish on ENI. Again, this is another one. Ticker symbol E, 5.79% forward dividend yield. So again, I believe it's another one that institutions are defensively positioning into. So CAJ, IBM, and KHC, E could be very defensive for us because of that. And then you've got GLD, GDX, and the next one, SLV, that are metals that are very defensive, that could do well in a market sell-off and a dollar decline in a lower interest rate environment. So here you've got your ultimate low on silver. You've got a higher low here. You've got this latest correction broken to the upside. It's come above its 50 and 200-day moving average, bounced off of that 200-day moving average. RSI has been heading higher. Your MACD's been heading higher. It broke its last downtrend cycle, back in here. Selling volume has been dying off lately, which is good. So a lot of positives there. So I'm looking for this to continue higher overall. So I'm looking for this ultimately to do this, but could it do something like this before it does this, or could it, could it go back here before, going up here? Yeah, absolutely. Anything like that could happen. But I'm very bullish on silver and what I believe that it's going to do, and again, it's a very defensive one for us. CHL is one that we will probably get out of just as soon as we're mildly profitable, just in case the Chinese do delist from the U.S. So when I gave the recommendation, there wasn't that kind of talk out there. So I don't have concerns with the company at all. It's still fundamentally sound, still great, market cap to debt, to its dividend yield, to its cash position, to its earnings, to all that. None of that has changed one bit. So I'm still a big believer in the stock, and it had its point of maximum pessimism in this area, and then that dropped off considerably. The MACD has been perking up again. The RSI has been perking up again. So I believe the sell-off likely ended here. We don't know that for sure yet. We got to see where this bottom halts at. But it would not surprise me if this low holds and then we go higher. Now, could this, go even lower than that and go to a lower low before heading higher? Absolutely, it could. And if it does, you can hit an averaging down point. If it hits an averaging down point in our portfolio, we're in at 47.75 on our original position. It's been down in the 43s. So you've had the opportunity to average down once, if you so chose, and we will probably beat back out of that when this bounces back up to around where this 200-day moving average is, which is right around the 48 level. So that really that will be one that we will be out of when that happens. And depending on whether you're pretty much break even in that or make a profit on it, probably depends on if you took advantage and did the averaging down, or if you did not. By the way, you don't have to keep and we've talked about this some on the site, but in case you hadn't been keeping tabs on the site, like you should be, you can put in limit orders for your prices. And I've already got the regions listed in the portfolio section as to where you can average down at. They're at the bottom of each newsletter. So at the bottom of each newsletter, there's this averaging down points area, and it tells you the two regions that I think you should have your two potential averaging downs, because your original entry is right in here, and then your two averaging downs are right in here. So you can set limit orders for those, and just realize if you set a limit order, put it good till canceled. And every broker may vary on how long that can stay good till canceled. Some it might be 60 days, some it might be 90 days. Others they might let you keep it on their books for longer and keep it open longer. So your broker can tell you how long a good till canceled order is. Some brokers allow it to be on there for many months before it would expire if the order weren't filled. But what you want to make sure is that if you've got limit orders out there, that you've got the cash in the account if any and all limit orders were filled all at once. That's what you want to make sure of. So never forget that you have limit orders out there and then think, seeing your cash balance and thinking you can use all that, because you can't if you have limit orders out there, because you've got to account for, hey, if X amount of shares at this price do trigger and it takes that much cash out of the cash balance to go towards the stock that just got triggered, I've only got X left. So if you do that, it's an advantage because when stocks hit those levels, it automatically buys and triggers. You don't have to think about it. You don't have to get emotional or non-emotional about it. It's very robotic. You don't have to watch and monitor the markets for it, and it automatically happens for you, and you're getting better pricing. And you're getting automatically more into it as it averages down, and you'll make a bigger percentage gain as it goes up, and you won't miss those points, because sometimes these averaging downs, they just spike down quick and go back up, and if you were watching it and caught it, you were there, and if you didn't, you missed it. But a limit order is there even if you're not there. So that's why I encourage you to use those buy limit orders at those prescribed areas. So you never have to ask, do you think it's a good buy or to add to a position at whatever price, because they're already pre-done, they're already pre-prescribed for you. And so all you got to do is look at the bottom of any newsletter, and that area will be there, and you can set up those limit orders and you can be done with it. Also, I keep a separate tab up, so when I go to the portfolio, I right click on it, and I say open in a new tab, and I keep that up on my computer screen at all times. And I also take my smartphone and shoot a picture of the portfolio, so that I've got it with me even when I'm away. So that's a tip if you've never done that as well. So CHL, I'm looking for it to ultimately bounce and head higher. And if the Chinese weren't getting all squirrely on us, and I get it. I mean, hey, we are in a trade war and tariff situation with them. So there's a lot of tit for tat thing going on there. But if that weren't the case, I would be far more patient and ride this up far more than the environment that we are in right now. So it's not being fickle. It's not being second guessing at all. Sometimes you have to be nimble and be versatile with the markets when you find out new pertinent information that changes things, and that is one of them that could change things. If they so chose to delist from the U.S. markets, it could change not the quality of the company or the fundamental soundness of the company, but an institution's aptness to put money in it, for public awareness, how much of that happens to be aware. I mean, just there's different dynamics there that could potentially go away if they delist it, and you can only get it, let's say, on the pink sheets or something like that. So anyway, so that's why that'll have us out of CHL probably when we were just a hair above break even. So this will not be a big money maker for you unless you have done the averaging down. Then it might be a decent money maker for you. All right, that is it for this week. Again, apologize for it being a little long, but I felt like I had a lot to talk and share with you, and so I hope you find it beneficial. Thanks so much for watching, and God bless. Bye bye.